Hello, everyone. Welcome to this masterclass by the Innovation Law Club Africa. This is part of our series of masterclasses organized for current fellows at the ILCA. This evening, we're opportune to have Bukola Bankole, one of the top tech lawyers in the country, specialized in technology transactions, private equity, you name it. So today she's going to be speaking with us on startup advisory, what to look out for when advising on fundraising. So I'll allow Bukola to introduce herself, but just before that, my name is Aaron Olajide. I lead growth and partnership at the ILCA. Hi, Bukola, how have you been?
Very well, Aaron. It's good to be here, and thank you for the quick introduction. I won't bore you guys. My name is Bukola, as I said. I'm a lawyer here in Lagos, and it's exciting to be with you today. I will like to make this as interactive as possible, but I will encourage you to simply raise your virtual hand if you have a question, so that if I need to go back on something, I can. And where I don't, then it would mean we will take it after the class. So it's 1 hour, and I will try to speed through things as much as I can. So good evening again. Yeah, so the topic that was provided is, it's a startup advisory, what to look out for when advising on fundraising. And it's a whole lot of things. So if you look at my initial overview, gone into some of the smaller detail, right, which talks about what the investment process looks like and what sort of activities, right, are involved in the transactions. But I mean, when I saw the people on the call, I thought, okay, we're lawyers. Let's have a frank conversation with ourselves. So, advising on fundraising, I've realized over time, is beyond documentation. And I see there are a lot of young lawyers in the house, and I thought, okay, you know what? I'm going to pause this presentation and start from another place. And that is helping your clients get investment ready. I think that's very, very primary and fundamental to advising on fundraising. Too many times I've come onto deals, but I've had to question, right, the investee companies, which is, why are your ducks not in a row? Why don't you have this? Why don't you have that? So spending the first 5-10 minutes to talk about housekeeping, I think that's the most critical aspect, right? When you want to advise on fundraising. It's not enough that we just find our clients and we tell them, oh, this is what the term sheet looks like. A very fundamental part, if you look at item 2 on my list, is due diligence, right? And that looks like it would kickstart some of the process, which we will go into in a very short while. However, because we're talking about tech companies, and you guys, I'm sure, are not strangers to these companies, right? Because you must be doing something in tech or be interested. And I bet you know how our tech entrepreneurs are. They want to focus on the tech, they want to focus on the business, and they don't want anybody to hold them back. So this is my opportunity to remind us that we're the, fixers. It's my opportunity to tell us that, we need to make sure that whilst they're focusing on the business, we're helping them, right, to get the corporate process tidy. And so I like to call that a sort of housekeeping or legal audit. So where you're already advising your tech clients from today, as a date, we can already establish, right? I think that's, even if we call it the in thing, is everybody wants to raise capital. Whether they need it or not is a different story, right? And so in raising capital, you want to make sure that you are ready, right, to receive the money that is coming. For you to get money that is coming, the investor wants to see that when they ask for documents, you have them. So many a times we've had to do due diligence on companies or talk to companies, young companies who want to raise money, and then we find they probably don't even own their intellectual property. It's probably owned by the founder, right? There is no assignment of intellectual property, or you find out that they don't have the agreements. A number of the agreements are probably not signed. You just find a lot of untidy bits. So I think your most important job as an advisor is to help your clients, right, warehouse their documentation. And I call that record keeping. Record keeping is extremely important, right? And what we find is companies either have no records, or they have incomplete records, right? Or they even have outstanding regulatory filings. So I will implore you, right, that when you go back to your, different places of interest and talk to your different clients, help them do an internal audit. Your internal audit is help them collate their documents, help them make sure that their processes are right, help them make sure that their regulatory filings have been done as I went due. So that when it's like seeing a beautiful girl, if you see a beautiful woman and she looks untidy, you think twice about approaching her. The same way you see a handsome gentleman and he has dusty shoes on, or he forgot to brush his hair, right? The same manner, you think twice, about approaching them. So your job is to make your people look good. So that's record keeping and helping them make sure that their records are up to date and complete and properly done. So check with your founders, right, where the corporate documents are. Check all of their software, who owns title to what. You'll be surprised that a lot of the websites sit in, different individual names. Those are smaller things today, but trust me, it makes a whole lot of difference, right? When you begin to talk to investors with your client, because again, this is a trick for you as lawyers. You don't want an investor to get on a deal and tell your client that we don't want you to use that lawyer, right? Because they've seen that, okay, if you haven't helped them or you haven't guided them till today, why should they keep you in the company, right? When the investor is going to have money at stake in the company, why should they keep you if you can't help the company, or if you can't guide them, right, to be compliant, or if you can't guide them, right, to look tidy? So that's my 2 cents, right, on that bit. And we can quickly delve into this. I know we've spent 15 minutes now. Apologies. Okay, excellent. Apologies again. Okay, so yes, let's talk about investments, right? When you want to fundraise, what do you want to think about, or what should you think about when you want to fundraise? And sorry, I don't know how to use this computer so much, so I'm mirroring the same thing on my iPad, and that's what we're going to be working from. So excellent. So what does a typical investment process look like, right? And you start with your deal identification, right? Your term sheet stage, which is where parties have discussed initially. So you either have a term sheet, or you have an expression of interest, or things like that, LOE or what have you, several names. But the more usual term, right, is term sheets. And I say more usual because now we've come to the phase of what do you call it, venture capital investing and whatnot. So more often than not, you'll find the term sheet in that phase of the work. Now, what is a term sheet? Is it binding? Is it not binding? And I'm going to spend, I think, most of the conversation today, right, focusing a lot on the term sheet, and I would like to come back to it. So our day today will be focused on what you should look out for in term sheets and mistakes that are often made during negotiations, amongst others. But before we go into the term sheet in detail, because we can't go through all of the things I've listed, I'm just going to take us through the investment process, and we'll take it from there. So after your term sheet will typically identify that there needs to be a due diligence to be conducted. And more often than not, of course, you will find that the term sheet would indicate that it's subject, right, to a satisfactory conclusion of the due diligence, if anything. So term sheet, and then you go to documentation, legal documentation, then you obtain approvals, for satisfaction of conditions, amongst other things. And then we move on to completion. So these are some of the terms, but I'm just going to skip this page. Yeah, okay, anyway. So given that we're talking about venture capital investing and whatnot, I think one thing I can also start with again, for your purpose, what to bear in mind when you're fundraising is, you guys would have heard all sorts of rounds by now. You would have heard seed round, you would have heard Series A, Series B, and several other rounds, right? So I just thought I should give you the comfort that they are nothing but alphabets, right? It's nothing to scare you off. There's nothing peculiar around it. What you find though is the one precedes the other, in the same way you have alphabetical order and whatnot, right? So venture capital investing, which is what I'm going to deal with, is what we've been typically finding right now in the tech space, because a lot of it is early stage financing deals, right? And this is where venture capital, focuses. So they usually take place in rounds. You start with the seed round, which would more often than not be investment that is coming in around the concept financing stage. And then you go to the Series A, and here you find let's say for product development or the initial marketing that they need to do. So that means, they've gone beyond concept, and they're now making some progress. And then you have the Series B and the later rounds, which deal with maybe completed product development and whatnot. What you find is there are also different investors who choose where they want to play. There's certain investors that they only play in the Series A level, that you will not find them in later rounds. There are investors that play in the later rounds who probably need a bit more sophisticated or grown companies, right? And they won't play in Series A round. So investor appetite, right, varies. So where you're advising your clients in fundraising and where you're holding their hands, right, through what they're doing, one of the important things is to help guide them in steering them into the right directions as well. Right direction being that if your client is trying to raise a seed round, except where you're trying to keep an investor abreast of what you want to do in the future, there's no point spending all of their time, right, talking to an investor that plays in the Series B space, right? So advising your clients to do their due diligence, understand the investors they approach, all of those things may seem little, but they definitely do matter. So again, even though I've mentioned that some of these rounds exist, right, one of the things you must remember as well is it's not as if they are required, right? Which is why you find some companies to just say that, well, they have an equity round. So the fact that we have all of the alphabets, right, doesn't mean you have to say, oh, it's a Series A, Series B, or whatnot. It's really equity they're raising, or who knows? It could be safes or whatnot. But anyway, most of these rounds are structured differently. Now, at the seed stage, you'll find a lot of safes, which is the simple agreement for future equity. If we have some time, we can talk about it a little. You have the convertible preference shares, convertible debts, and things like that. And you find that really in the early on stages, which is maybe around the seed round, where maybe either evaluation has not been done, or you're waiting for, I'd say, qualifying financing or something else. Anyway, so the different series will have different valuations, and you deal with vesting of shares, or milestones or things that they need to do. But anyway, today we're going to talk about the term sheet, which kickstarts all of this. And my focus is on the term sheet today because a lot of deals are made at the term sheet stage. So when you're advising on fundraising and when you're supporting your clients, it's important to drum something into their ears, which is, don't just say, oh, I just signed a term sheet. As a lawyer that supports an investor, one of the first things I do on deals, I tell my clients that, okay, we're not going to agree to any revised terms because we've agreed a term sheet. Now, what do you think that means? Hopefully I don't get to, I'm not working across any of you on another transaction, but for want of a better word, it's our own little way of bullying and having our way, right? When you're supporting an investor. And why are you able to have your way in something like that? Because the potential companies, they just feel, oh, it's a term sheet, they can renegotiate deals at the end of the day. But you see, investors don't want to waste time. So please, I implore you, you need to pay attention, right? When you're negotiating term sheets, when you're supporting your clients, right? In negotiating term sheets, a number of the important provisions would already be documented in the term sheet, right? Such that it's always a bit too late in the day to want to change it. Even forget what I said about the fact that we'll try to have our way. The reality is there are also some investors, right, who do have to get approval for the terms of their term sheet. So coming back later to renegotiate it, right, could prove quite difficult. So let's talk about a few terms that we see in term sheets, and just probably spend a few minutes discussing some of those. So some of the most important terms you will find in term sheets, let me scroll and hopefully, the slide is there, is you find provisions, right, around what rights your investor is getting, the sort of protective provisions they will have. You have language around anti-dilution. You have language around right of first refusal or right of first offer, preemptive rights, and so on. If you agree to what you're not comfortable with in the term sheet, it's usually harder, right, to renegotiate out of it when you come to your core transaction documentation. So again, a term sheet is the level, is the stage at which you pay attention and try to get the deal that you find most suitable for your client in that situation, or at a minimum, a deal that works for both parties in that situation. So let's just take some of these, for instance, right? So we talked about anti-dilution, right of first refusal, preemptive rights. Anti-dilution, and I will just take a quick moment to explain it. Anti-dilution simply means if an investor is coming in to buy your shares, the shares of the company at 1 naira, which is, your client's shares. Let's imagine they're coming to buy it at 100 naira per share. The investor will typically want to put provision in the agreement, right, to identify what would happen in the event that your client happens to sell the shares to somebody else at a lower price. So that's what they call anti-dilution. Now, effectively, what would happen is two things. You can consider that, okay, well, doesn't a preemptive right take care of an anti-dilution situation? And frankly, a preemptive right protects you in an anti-dilution situation. However, that only enables you, right, maintain your pro rata rights. And I take it that, I mean, again, I keep reminding myself that we're all lawyers in the house. But if you have questions, please raise your hand. I'm happy to, explain or expatiate on some of these terms, right? So your preemptive right gives you, protection against anti-dilution. However, we need to also focus on pricing, right? Where you brought in your money at 100 naira per share is based on a certain valuation. And then you find out that the company is selling at a lower price, whereas you've brought in your money at a higher price. It means that somebody that is coming in after you will be getting way more shares, right? For the same value you probably brought. So investors like to protect themselves in this instance. Now, as a lawyer advising an investing company on their fundraising, I'd say when you come to your anti-dilution, it's important that you pay attention, right, to how long that anti-dilution provision is for. Please, for the love of God, your anti-dilution provision is not open-ended. It is not a situation of throughout the existence of the company, if they ever issue shares at a lower price. No, it doesn't work that way, right? So when parties are negotiating a deal, the company would have presented its projections and shown that these are the numbers it's going to do within XYZ time. So ideally, when I think of anti-dilution, I try to benchmark it, right, around what projections, right, the company has given. If they've indicated between year X and Y, they're going to be growing astronomically, right? I would, be looking at capping my anti-dilution, for the first 3 years or for the first 5 years, just to make sure that my money is actually indeed coming to work for me. And that if by any chance something goes wrong, right, I know that I'm protected and your shares will be recalculated as if it was given at that lower value that anybody else knew is coming to take it. So pay attention to the year, pay attention to how the anti-dilution, how the adjustment is done, right? And there are two general ways to do that. And I think you guys will spend some time to sort of understand that on your own. We have the broad-based and weighted average, right? And the narrow-based, and these are just terms. You just need to figure out the calculation. So anyway, that's on anti-dilution. Right of first refusal as well. That's something else you need to pay attention to. I'm sure this is not a concept that is new to most of you. But the right of first refusal, it may seem like it's a small issue, but of course it could also be a major issue, because you're wondering, okay, if Mr. X wants to sell his shares, who should those shares be offered to first? Depending on who your client is, right? If you're working for the company, you're probably thinking, okay, if the investor wants to go, do you want to negotiate with the investor that they should offer you the shares first before they go to an outsider? Although most investors, would not agree to that. But those are things to definitely think about. So these are just even some of the smaller rights. We're going to go ahead and talk about some of the more critical terms, right? And that will come around exits, liquidity, conversion rights, and so on and so forth, right? One of the key terms that you would find is, you remember when I spoke earlier, I said there are different forms, right, in which what's it called? In which the instruments could be. It could be a safe, it could be, issuance of preference shares or whatnot. Now, so take for instance, liquidation preference comes in for preference shares. For the Nigerians in the house, I mean, I'm sure you understand what the liquidation preference is. Your CAMA guarantees you that as, a holder of preference shares, right? However, in negotiating and advising on your term sheet, one of the things you must focus on is, how is a liquidation preference calculated, right? And we have different forms of liquidation preference. We have what we call the non-participating preference. We have the capped participating preference. We have the uncapped participating preference, right? And the uncapped participating. Now, I'll give you three scenarios, right? I've mentioned to you that there are three types, right? The non-participating simply means that, okay, so in a liquidation event, right? And so before I go into the three caps, a liquidation event, it sounds to you guys like bankruptcy, insolvency, or any of those things. However, in these transactions, the transactions have become more sophisticated because they know that there are different ways, right, where value could be taken out or value could be gotten out of the company. So your definitions will typically include mergers as liquidation events or a change of control. That means anyway, value is going somewhere, right? Somebody is exiting, somebody is coming in or whatnot. Money is going to change hands, you know. So you want to pay attention to how this is done. So one is that when you're distributing the proceeds, right, you want to make sure the preferred shares, right, they get a certain amount of money before the ordinary shareholders, right, get anything. Now, what is that certain amount of money is left to negotiations and what parties have agreed. A lot of transactions, the certain amount of money is their exact investment. Remember, it's a liquidation preference in the event of a liquidation, their exact money. There's some of them that it's the sum they brought in, you know, it's 2x of it, 1.5x of it. So it varies. But what are the forms? Now, non-participating means you've said to the investor that in the event of a liquidation, you're going to get XYM, you're going to get your original purchase price back, right? Plus any declared but unpaid dividends. So that means what we owe you on a liquidation event, right, is you get this back. That is what we call non-participating preference. So the language will probably read that when the liquidation occurs, blah, 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 you're going to first of all pay to the preference shareholder their original purchase price on the preference shares, right, plus any unpaid dividends, declared but unpaid dividends. And that any proceeds after they have paid the preference shareholders will solely, any proceeds after that will then be distributed to the ordinary shareholders. So can you see there's a distinction, right? Preference share people get first, so that if the money is not enough at the end of the day, you won't have distributed them with everybody, right? So they first get theirs first. So whatever is left will then be shared will be shared amongst, ordinary shareholders. That is the non-participating. Now, we also have the capped participating. Now, the capped participating could say that we'll first of all pay the preference shareholders, right, the exact, what's it called? We'll first pay the preference shareholders the original purchase price per share plus any unpaid dividends. We'll now say the balance will be distributed pro rata to the ordinary shareholders and the participating. In some other languages, they like to call this double dipping. So that means the guy has taken his chunk of money, is gone, right? And then you want to give him out of the balance that is left. Now, this is the capped participating, because you're saying you will give to the preference shareholders up until they have received maybe 2 times their money. So that means they will distribute pro rata. At the moment that the preference shareholders have received 2 times their money, you stop giving them, right? And then you give the rest to the ordinary shareholders. That is a capped. Now, you would also see uncapped participating preference, which means you will give the original purchase price or 2 times or whatever it is you've agreed, right, with the investor. You will give it to them as the preference shareholders. And then the balance of the proceeds, you will still distribute pro rata to everybody. That's the complete double dipping. So it's not enough that your document says liquidation preference. You need to be clear on what the liquidation preference is. What are you and your client comfortable with? What do those returns look like? What do those numbers look like? So liquidation preference is something I would advise that you pay attention to. Another point I would like to take, and I'm trying to take the quick one because I'm conscious that we have limited time, is dividends. I'm sure you all know what dividends are. Some of you have stock, right? So the dividend is how you get your returns, right? Again, this is also mostly applicable, right, where preference shares are issued. And frankly speaking, I'm focusing on this a lot because that's what you find these days. Now, why preference shares as against ordinary shares, if you want to ask me, right? Investors have gotten comfortable with that because they get this, and especially, this early stage investors, right? Because one is that they're taking a gamble, right? And so at a minimum, they want to know that if there's going to be a rainy day or if something is going to go wrong, right, that their value is somewhat protected. Remember, a preference shareholder, right, it has that liquidation preference which we talked about. The law gives them, and you can also by agreement even make it tighter. So that's, really the distinction, and that's why you see a lot of, preference shares being issued, today. So the dividend, you have fixed dividends. Right? You also have all sorts, right? Are there preference shares that don't have a fixed rate dividend? Correct, there are. And those are from generous investors. However, what you find is that for a preference shareholder, they would already agree with you that you must give me, you owe me, not you must give me, let me take that back. You owe me 8% per annum in dividend when you declare. I've also seen some that say you owe me 8% amount in percent in dividend every year. Now there's a difference between the two, and I'd like you to be extremely careful about that. When you say you owe me per year when you declare, it means that the year that the company does not declare dividend, right? The year that the company does not declare dividend, what happens? Nothing. That means you don't owe anybody money. However, if the language says that they're entitled to X% dividend per annum, it means whether you declare or you don't declare, you owe them. So where you have not declared dividend, you will carry that 8% on your books as a debt into the next year. So it's cumulative. Your dividend continues to run. You just feel, oh, you didn't declare dividend, but unfortunately, you did not capture all that. Your dividend is when declared. So please pay attention to your dividend provision when you're advising on fundraising. It's extremely important as well for you, right? These are key things that you must negotiate and properly document in your term sheet. So you know whether it's cumulative or non-cumulative so that you know what you're in for. Otherwise, you will let your client, accumulate debt without realizing. So this is extremely important as well. So what's it called? In addition to this part on dividend, there's also what we call participating and non-participating, right? The participatory bit really simply means where they're entitled to a fixed dividend, right? The dividend will be given to them first. And where they're participating, it means that the rest of the dividend, right, that you want to distribute, you distribute to everybody as if the preference shares people, right, were holding on ordinary shares, which is what we call on an as converted basis. Do you get, like, as if converted? So you share with them again. So please pay attention. Where you only intend to give them the fixed and move on from it, let it be clear that it's not participatory, right? And where you're generous and you intend to continue to give them anyway, then just make sure that you have it on lockdown, that you're clear about the rights that are being given, right? All of these slip-ups, right, occur with, one or two, tiny, mistakes. And so that's why we're on this call today. And we want to make sure that it does not happen to us as excellent lawyers that we are. So we've talked about anti-dilution. We should also talk about, let me see real quickly in how many minutes we have. Yeah, we should also talk about exit provisions, right? One thing you should already know today, the first thing an investor thinks about when he's trying to make an investment is exit. Yes, it may sound very strange to you, but they start with the exit in mind. What do I mean by that? It means that they want to have a clear path. How are we getting out of this? How are we going to make our return? What is going to happen? So you will find exit provisions, right, that would describe that would describe how, right, the investor is supposed to exit. And there are a number of things you would find, right? You want to make sure that when the exit provisions are being drafted, it doesn't say that, oh, your client is going to maybe redeem their shares or give them money that they don't have, right? I was recently advising an investor on a deal, and I got on the phone with the investee company, and they said, so we've seen your agreement, we understand everything you've done, and we see that you said that by year X, if there has been no qualifying finance, money and whatnot, then we're going to have to buy you out. And the gentleman said frankly to me, maybe we shouldn't bother to do this deal, because effectively we're doing this deal because we don't have money. So on the date you said we'll have to buy you out, if there's no qualifying financing, we won't have that money to buy you out, right? So there are a lot of things people always need to pay attention to. So you must understand the peculiarity of your individual clients, right? Where they are, what they do, so that you can pay attention to all of these agreements and these things that you are binding them by, right? So exit could also be that parties agree in the document already that, oh, that it's going to be maybe via an IPO, or it could be that parties agree to work together to sort of secure to sort of secure a trade sale, a strategic investment, or maybe divestment to another venture capital fund or to a private equity fund and whatnot. So just pay attention to, the sort of exit that you have, so that so that you don't have a put option where you didn't intend not to have it, right? Which is where they give it to your clients, okay, buy us out, right? And making sure that, okay, how is conversion to be done, amongst other things. So those are things to also pay attention to. Some of the things that are also very important, right, is governance. Governance controls, as seen on the screen right now. What kind of power are you giving out? What kind of power are you giving away, right? Are you getting an investor? Are you giving the investor a board seat? What happens where you are having a group of investors? Are you trying to give each and every one of them a board seat? Or are you going to say, oh, one, we're only going to give a board seat to the lead investor, right? To the lead investor. I've just seen a question from Lawrence, and once I'm done with this, I'm going to attend to it, Lawrence, or we can take it at the end of it. Thank you. Okay, so, or are we going to give the board seat to the lead investor? And then what if you have another powerful investor, right? But their money was not the most, and you're not ready to give them a board seat. Is there a way you can satisfy them? Can you maybe give them an observer right on the board? So you need to pay attention to, your governance control, so that you're not fighting a lost battle down the line. Your term sheet is the most critical document. I would say this again, right? For when you're, advising on this fundraising things. And I call it the most critical because the most critical for the investee company, right? Because more often than not, you rarely negotiate out of it, or you're in a weaker negotiating position after your term sheet. So it's very important that you pay attention to it. And this is the joke I always tell people, right? And I take it that most of you are advising a lot of startups, tech founders and whatnot. There is a difference between CEO board seat and founder board seat. I'm very, very generous with that advice, right? So I'd like you guys to pay attention. Where a board seat is promised to the CEO of the company and your client, who is the founder, is the CEO, please remember that means when he's no longer the CEO, he is not entitled to that board seat. So think with your client, what do they want? What are you trying to achieve? Those are things to pay attention to. If what you want is a founder board seat, specify it. If what you want is a CEO board seat, specify it. But please do not make the mistake of using them interchangeably. If he's the CEO and also the founder, let it be clear that your founder is getting a board seat, and and you can write that, and if you write CEO board seat, all well and good, and you can capture that where he's no longer the CEO, you must still get a board seat. I mean, just make sure you negotiate for exactly what you want, so that your client is not calling you years down the line saying that, Bukola, you advised me. What happened here? Now I've been pushed out, So those are the things you need to pay attention to. I think we talked about some of these already. So let's also quickly talk about some protective provisions. Okay, excellent. Here too. So protective provisions are what sort of rights are you giving to your investor, right? And you can find protective provisions in a few things. You can find provisions that will probably say that you can't do certain actions without the investor approving. Or clearly, that's a veto right. Somebody has a veto right. Another thing could be, okay, you could say, rather than a veto right, it could be that there are other smart people. So we understand, Mr. Investor, you want to protect your investment, but there are equally other smart people here, right? Or people who are equally important. How about we have a threshold? If you say 80% of the shareholders must approve a decision, So there are different ways to skin it, but as I've said to you, you must understand the nuances for your particular case, understand the peculiarity, of your specific clients, and, you'd be able to distill and make decisions from that, right? What else should we talk about as well? Let me see other rights that we should deal with. Okay, so on the screen, we also have the drag along rights. So hopefully you guys know and understand the concept of the drag along and the tag along rights. The drag along is also one that is very important. A drag along right simply says, if Mr. X wants to sell his shares to a third party, and that third party that is trying to buy Mr. X shares says, oh yeah, I'll buy your shares, Mr. X, but you know what? I find your company attractive. I want to buy all the shares. If Mr. X has a drag along right, that means it can force all of you, right, to sell your shares, even where you were not intending to sell it. So drag along rights must be used carefully. You can't just give a single share holder, right? A drag along right where they hold a small number of shares. Imagine somebody that holds 2% in a company having the power to drag everybody along, right? It doesn't make sense. Even when you're advising your, say, investee companies, right? And your investor wants to drag along, right? Make sure you've thought about it thoroughly, right? That it will be to your advantage when your investor wants to drag you along. But if you reckon it will not be, then don't accept a drag along right. Drag along rights, however, they're nice to have in some situations, but just make sure that the power for the drag along is really not left to people holding small fraction of shares, such that the people who actually then wield the power or wield the shares are left at their string or their beck and call or whatnot, right? So that's something else to bear in mind. Tag along rights are important for people that want to take advantage of sales by majority shareholders. So let's say, for instance, you got an investor who brought a lot of nice money into your company. An investor wants to exit tomorrow and they found a really nice buyer, but they're only talking to the investor. If you have a tag along right, that's your jackpot. You get the same price, right, that the investor is trying to get, because you say, oh, Mr. Investor or Mr. X, right, or Mr. Founder, you want to go? No problem. I also want to sell my shares. And the gag is you get the same price and whatnot. Just make sure your drafting, right, adequately covers it. Information rights, those are clear. One thing I've also found, right, is it may seem simple now, but it's also got to bear in mind. Information rights are all those things where the right will provide us your monthly financial statement every 20 days after the month, provide us your quarterly every XYZ. Now, why is this part important? It's important because a number of these companies that we support, right, in this tech space, they're small. So it's important that you run the information rights by them, because some of them don't even have financial controllers or CFOs. So sometimes the information right poses a drag to them and they're already contractually obligated. So make sure that, you carry your clients, along so that they're clear. What is the level of information? What is the frequency? I've had people negotiate that, oh, we want to provide the information, but it cannot be monthly. We can do it quarterly until, we are more developed and, things like that. So always pay to who your client is and how exactly, you can support them specifically. Let me see if I've not missed anything. And there are a few other things, right, that are also important. One is employee option, and the other one is vesting. Now, vesting and employee options, they're two different things, even though somewhat related, but it will be good for you to also pay attention when you're negotiating these, when you're doing this fundraising with your clients, right? For several reasons, there are investors that would want, right, founders to earn their shares. If not all of them, a portion of their shares, right? That is the vesting, right? That's the vesting bit. So you must pay attention. What works for your client? Okay, why is the investor asking them that a portion of their shares should vest? What's that portion that is supposed to vest? What is the vesting period? Apologies. What is the vesting period? Over what duration? How does it vest? There's some other provision that would also require that your founders cannot sell their shares, for a certain number of period. Of course, that's to ensure alignment, right, with the investor, because they don't want to put money in the company and then you want to exit and run away, right? So it makes sense from an investor perspective, but you must carry your client along. I think the biggest job we do, right, as lawyers is hand holding, especially with this financing and fundraising, right? It's hand holding. You must support your clients. You must be clear about what is being done. And as lawyers, you can't run away from maths when you want to come and play in this space, right? From your cap table, right, to numbers, to years for vesting and a few other things, you must be on top of your numbers game so that you don't let anything just slip through. So those are things that are actually super important. The last one is the ESOP I mentioned, and it will be good to talk about it as well. The ESOP is the employee share option. And as you know, right, these are set up, right, to ensure alignment. So companies want to incentivize their staff or the new hires they want to bring. And so they're going to say, oh, we're going to create an employee share pool so that we can, give shares to our employees, and it will set out the timelines and whatnot for doing this. Now, at fundraising, something is very important. I tell my clients this, right, who are investing companies. Don't create an ESOP where you don't want it. Now, what do I mean by that? If we set up the company today and the the investor comes and says, oh, we're going to invest in the company, we'll create your ESOP already so that, you can use it to bring people on board. Your nice response should be, oh, absolutely exciting idea, especially if you're not ready to do the ESOP. We will definitely do the ESOP, but it's not the right time for us to do the ESOP because we've not identified people and we think we'll take the decision with you as an investor later in the day, And why do I normally advise this when I'm advising companies? Because if they don't need it, they don't need it. What happens in that situation is if you create the ESOP before the investor comes in, then only the existing shareholders take the impact of the ESOP because they get diluted for having created the ESOP, and then the investor comes right on top of that. Please, ma'am, take my words carefully, right? There is no problem with an ESOP if you actually need it, if the gap is clear, if it's one of the things you had identified you wanted to do. But where it's not, you shouldn't be forced into creating an ESOP that you're going to leave hanging. You can do the ESOP later. The only reason an investor may say, okay, let's do the ESOP now is because they don't want to have that impact, right, of the dilution later when the ESOP is created. However, the way I think about it is we are creating value together, right? The investor, the founders. So it's not a dilutive situation. We don't need it now. As we continue to build the business together and create value together, right? We'll create an ESOP and, it will be balanced and, we'll identify how much ESOP we even need to, shares we need to set aside for the ESOP, and we'll balance things out. So there are always ways to, have these conversations and, just move around, with your, investor or other potential, right? So those are things that are important. So say from my experience, the things that, people, founders and investors tend to go back and forth on really around this ESOP that I've mentioned, the veto rights that I've told you about, the anti-dilution, which I've also mentioned to you about, the investor rights and protections, the governance matters, exits, which we've discussed as well, and liquidity. So you remember all of the things I've said? I hope you do. Those are the reasons why they go back and forth on them, because one party wants it one way, the other party wants it another way, right? It's important that parties are clear, parties are aligned, and they're able to figure out which way to go. Hopefully, at some point or the other, or maybe another tutor is going to take you guys. We'll probably get to discuss why people use safes, why they use convertible notes, and all of the other fancy instruments. I know we cannot get to it on this call. So I've been told I talk fast a few times. I really do hope you guys got me, but I will then like to go into some of the questions, and I will take some questions. So if you want to speak, feel free to raise your hand, your electronic hand, and I will call upon you in a second. So the first question I have though is from Lawrence. Let's see. Lawrence says dividend is like profit. How can you carry over dividend payment obligation when no dividend was declared? I can relate if profit was made and perhaps the company declines to declare dividend. Please explain further. Excellent, Lawrence. Okay, so so let's say, for instance, you say to someone, oh, I will give you $1,000. Meanwhile, you said I will give you $1,000, you've already identified your source of the $1,000. But when your source of the $1,000 does not come, you still owe $1,000. That's the difference between when you said that dividend declared but unpaid, right? And dividend. So it's contractual. When we've said Mr. X has invested $1 million in the company, and Mr. X Limited, right, shall be entitled to 8% per annum as dividend in the company. You promise them they will get 8% yearly as profit. So whether you declare it, whether you don't declare it, you've promised them they're going to get 8% monthly, yearly. So the reality is, we don't like to call it that in the investment world. It's a coupon. So you're absolutely right. It's almost like an interest, right? But no, we call it dividends, right? So to the extent that you have not said when declared, only when declared, then you owe that sum. So it will be recorded in your books that you owe Mr. X Limited 8% from 2019. So when you come to 2020, you also don't make money yet. You didn't say declared and only when declared. That means you are owing 16% on your $1 million. I hope that makes some sense to you. So Adele Adams, most likely I would try to, he's asked me to, or she's asked me to share the presentation. Yes, I will try to sort of streamline it, because I realize I wanted to narrow it down for this class, but it was too late, right? So the presentation I shared with you, you'd see that I skipped over a number of parts, because I focused this class specifically terms, right, and those preliminary stages. So I will do my best to get it across to you guys next week, but it's a very busy weekend for me. But yes, I will share it. Okay. All right. And then to Opaya, thank you. Oshiyemi, thank you very much. And then Omotolabudu, can you explain how a company's valuation affects funding? Okay, so let me see how best I can describe that. So I wouldn't say that a company's valuation affects funding, right? But it's one of the things that parties go back and forth on. So take a look at me, and I'll tell you today that, hey, I'm Bukola, I'm a partner at TNP. TNP is a significant business. We're top tier commercial law firm. I'll tell you that, we are tier X, we're tier Y. I'm worth X. And then a Clifford Chance, a White and Case, comes to me and says, oh, excellent, you're doing a great job, but I don't think you're worth more than what? Tier 4. I'll put you in tier 4. I'm like, hell no, I am in tier 2. Haven't you seen the ratings? Haven't you seen the rankings by IFLR Legal 500? And they'll tell me, okay, well, let IFLR and Legal 500 buy you, right? So parties always argue on valuation because the metrics they are using is different. Any law firm can say that, okay, we're tier 1, and then somebody else, it's just business, right? So that's just, an example of what I just really want to drive it home. So it's the metrics the investors have used, they probably don't agree. They probably feel this idea, this concept that you think it's worth X, when we've done our analysis, it's really just worth C, right? So that's how valuations, come about, right? There are different metrics to it. The investment advisors are, best placed to do that, but it's a lot of numbers game, right? Now, how does it affect funding? It affects funding because, so it doesn't affect the amount you're getting. It affects how much of your equity you give away. So if your valuation is $5 million, that means if I'm bringing $1 million, I'm getting just maybe 20% of the company. But imagine if your valuation is $2 million and I'm bringing this same $1 million, I'll be expecting to get about 50% of your company. So that's how valuation affects things. So this is actually why a number of those documents, right, which I mentioned at the onset, have come to be. We've talked about the simple agreement for future equity. We've talked about the convertible notes, right? This is what spurred them. We realized that, and people realized that, the professionals realized that a number of these companies are probably too young, and any valuation, right, will be subjective and based on the valuers, what do you call it, thoughts and their own principles, whereas someone else thinks otherwise, right? Some other school of thought is, the company is even too young for you to do evaluation. So how, this is being bridged in the market is instruments like the safes and the convertibles. So quickly to touch on the safes, right? The simple agreement for future equity is simply an agreement, right, where parties agree that, okay, you know what, you need $100,000. Here is $100,000. I will give it to you, right? And this $100,000, if the company had a valuation, you would have said that, oh, I will give you this $100,000, and once I've given it to you, this is how many shares you would get. But because there's no valuation, we cannot say how many shares we will get. So I'm taking a leap of faith and giving you faith and giving you the $100,000, and I'm saying to you, no problem, you're still growing. By the time you raise you raise a valued round, right, which we call qualifying financing or whatnot, you will issue shares to me at that valuation in the future. So I've taken a leap of faith and giving you money ahead. However, as you know, life is not charity, right? Everybody is doing this as a business. So what then happens is those safe agreements, you would typically find that, okay, I'm giving you this money as a leap of faith. When you raise X or when you're valued, I would convert it that round, but with a X% discount. So that means Mr. Y that is coming in the future, who is going to help us set valuation, right? If he's going to buy you at 100 Naira per share, I will tell you I'm going to get a 20% discount or a 10% discount. So that means I will be buying at 80 or 90 Naira, right? So that's one of the ways, right, to fix the valuation problem, right? Same with the qualifying financing, convertible notes and whatnot. Excuse me. So those instruments sort of came in to help bridge that gap. Okay, if we don't want to do the valuation now, if we realize that it's at a stage where valuation will be subjective and parties cannot agree, then those instruments, get to be used. Otherwise, you find that I've seen a lot of deals, right, that are falling through simply because parties could not agree on valuation. Because think about it now, it can even be annoying. You're thinking you're worth 7 million. One investor comes to do DD or, comes to evaluate you and they tell you, oh no, this number is really 3.5. So those are the sort of things. So I hope I managed to answer your question, Omotola, but so it's really about how it affects, right? The financing, as you said, right? That's how it affects the funding. It affects, what you eventually give up, right? So in founders not trying to give up so much and investors trying to make sure that, okay, we do what is just and fair, is why they've come up with all of these, beautiful structures like the safes, amongst others, right? So is there any other question? Thank you, Emmanuel. Thank you, Garrick. I don't see anybody's hands up.
Thank you so much, Bukola.
Excellent, Aaron.
Yeah, so I was sort of tempted to ask you questions on debt financing, but I realized that might be totally out of scope, which appears to be fully focused on equity. But if you want to touch on that, that would be great. Just probably speak about whether there are actually debt financing options for startups, and what that would look like, particularly because they are still at early stages. I think that would be something that would be great to look into.
Okay, so yes, absolutely. And one of the things that I even mentioned is convertible notes, right? If you're not doing traditional banking financing, right? Reality is you're going to be taking some form of equity, right? Or some form of debt. Now, what you find with the startups is we also know, right, that there's probably no money or whatnot. So that's why you have what you would usually find is convertible notes, right, or convertible preferred shares or whatnot. It's the opportunity for the investor to make the debt available, the money available to you, right? And what you'll find is the notes will probably maybe bear interest, but the interest is not paid annually, right? So interest may be accumulated, and interest, the document would already be specified that interest will be converted at the same time, right? At the later stage. So it could also be, the convertible preferred, which is that you carry your money as you carry the investment as preference shares until you convert it to plain equity, right, later in the day, which is ordinary shares. So it's different, ways, right? Some of the safes that I've even mentioned, in fact, some of them are such that they have been repaid. So until you've given the man his shares, right? Really, what do you have? So effectively, you've taken some form of money, right? And your accountant will record it in your books, right? But yeah, so convertible notes are used, convertible preferred, shares as well. They come into play in terms of debt financing. Aaron, to start out.
Absolutely. Let me not ask further questions on this because of time. But Bukola, it's been a very, very detailed session. I'm sure by the time you also share with us the presentation as well, people will also be able to follow more. But it's just really great having you this evening to speak on this topic, and we're really, really grateful. Now, there is a young lawyer out there, 2-3 years post-call, who is saying, I really want to get into advising tech companies on major transactions. You've been in the industry for over a decade. What are your top 3 advice you have for that person?
What a day. You want to advise tech companies. Okay, so I think the first one will be support them, right? Don't let anybody deceive you that it's all glitz and glam. There's a lot of free work being done in this space. So get ready, right, to share your knowledge. Get ready to provide support, be a listening ear. I think absolutely, right? The first step is being able to support and share, whatever knowledge you have. Another thing I would say is, let me see, you want to advise tech companies. It also build your skills properly as well. You'll find that they run into a lot of interesting or novel issues, right? Because it's a developing space in Nigeria, right? So build up on your skills as well. You'll be surprised, right? And before my tech lawyers, my tech entrepreneurs catch me, right? They really don't like to pay a lot of money, but they want quality work. So they know when they have quality advisors, right? So you can't bullshit them and tell them that, because you're doing it for free or for next to nothing, they know what they want, they know what they're getting. So you must brush up your skills as well. So Aaron, two nuggets.
Okay, thank you so much. You got me when you said free work, guys. I think I've lost count at the moment. All right, thank you so much, Bukola. It's really nice to have you. Everyone, this video is going to be available on YouTube, so you can definitely catch up on that. And then we'll try as much as we can provide the presentations once we have it from Bukola. Thank you so much, and our regards to our friends at TNP.
No problem at all. Thank you.
Bye, everyone. Bye.
All right, cool. Have a good one. Cheers.
Bye.